You've been there, right? You get a winning streak going. You feel like the next Wall Street whale, and then, bam! Revenge trading hits. You violate your rules. You bet your capital on a trade you found on Reddit, and you blow up your account. You do the walk of shame, stare at the ceiling, and repeat the same mantra. I just lack the discipline. My psychology is broken. I'm here to tell you that, for most traders, that is a lie. Trading psychology is not your problem. It's a distraction. Trying to fix your emotions before fixing your system is like trying to drive your Tesla with no battery and blaming the steering wheel. Your fear and greed are not your weakness. They are a rational response to a broken process. This video is going to give you the blueprint. We're going to prove why the edge must come first, build the mechanical firewall that protects your money, and finally, conquer the 3 specific psychological traps that only emerge once you start winning. This is the truth about trading in 2025. Let's get to work. Part 1. The psychology trap. You cannot manage what is not there. Let's talk about the modern American market. Trading is hyper-accessible. Apps like Robinhood made it a dopamine hit. We're flooded with news, analysis, and social media hype. This environment creates the illusion of expertise. We spend 5 minutes learning an indicator, put on a trade, and when it fails, we default to the easiest blame: our mind. The data is ruthless. Over 95% of retail traders lose money. And I'm telling you, most of that massive failure is due to a simple fact. They have no statistical edge. Think of it. An edge is a mathematically proven, positive expectation. If your strategy wins only 40% of the time, and your average loss is bigger than your average win, you are guaranteed to fail. You are gambling. You shouldn't be trying to manage your fear. You should be grateful you have enough sense to be scared. Stop reading self-help books for trading. Start building your foundation. Part 2. The edge. Building the mechanical firewall. It's a machine designed to take small, calculated risks. 1. Define your trading playbook. This must be a checklist a robot could follow. It answers 3 questions. Approach. What is your core strategy? Is it a New York open volatility strategy? Or are you focused on midday consolidation breaks? Define it clearly. Entry/exit criteria. What are the exact signals? Price must reclaim the 9 EMA and the RSI must cross 50. No subjective feelings. The firewall. Position sizing. This is the single most important rule in all of trading. You must risk no more than 1% to 2% of your total trading capital per trade. This rule is your emotional shield. If you know you can survive 50 consecutive losses, you suddenly have the psychological freedom to execute your plan. 2. Prove it. Backtesting and expectancy. Now, you prove the edge is real. Backtest your rules against at least 100 past trades. You need to track these 3 numbers. Risk to reward ratio. How much you win versus how much you risk. You must aim for 2R, win $2 for every $1 risked or higher. Win rate. Percentage of trades that are winners. Expectancy. This is the holy grail. It tells you your average profit per $1 risked. If E is positive, you have a working edge. If it's negative, your strategy is trash. Go back to the drawing board. Only after forward testing paper trading confirms your positive E, you risk real capital. You now have a working machine. Part 3. The true psychological firewall. Conquering the 3 biases that kill a winning account. Okay, you have the edge. You know you should win. But now, your evolved human brain steps in to screw it up. Here are the 3 biases that will kill your profitable system, and the tools to defeat them. 1. Loss aversion, the stop-loss killer. The problem. Your brain hates realizing a loss. It makes you move your stop-loss or not place one, turning a small, defined risk into a catastrophic event. The solution. Automated stop-loss. Your emotions cannot interfere with an order that's already placed. Hard, automated stops remove the human from the decision. You set the rule. The machine enforces it. 2. overconfidence, and greed. The 1% rule breaker. The problem: you have 3 winners in a row. You feel like a genius. You ignore your 1% rule and risk 10% on the next trade because you're due for a win. This is greed, amplified by market euphoria. The solution: daily max loss limit and forced breaks. Set a hard cap. If you hit a 3% drawdown for the day, you shut down your screens. No negotiations. Get up, take a walk. Let your ego cool off. Your process is more important than chasing one trade. 3. Confirmation. Bias and FOMO, the social media saboteur. The problem: you're in a trade and now you're scrolling through Reddit, only looking for posts that validate your position. You see hype for a stock outside your playbook. The solution: market-neutral mindset. You are a scientist, not a believer. Mute your social media during trading hours. If you feel the urge to chase, immediately check your playbook. If the trade doesn't meet the criteria, the trade does not exist. Conclusion: the mastered trader's mindset. The truth is, trading is 100% mechanical process and 100% psychology. You just have to tackle them in the right order. Step 1. Build the edge. Prove your system works with data. Step 2. Protect the edge. Use your 1% risk rule and automated stops to firewall your account against your own mind. Stop trying to meditate your way to profitability. Start building the system that makes discipline automatic and easy. You now know the uncomfortable truth. Don't get trapped into the same trap that I was in. And guys, and I know a lot of people are in the same trap, where we just keep blaming trading psychology, emotions. Once again, that's a fair statement only when you have developed an edge. If this video was a wake-up call, hit the like button and subscribe. And most importantly, share this with one friend who you know is stuck in the emotional trap. Let's shift the narrative. Your transformation starts right now.